Wait till housing starts to tank, commercial real estate starts to tank, and stocks are pulled down even further by the real estate industry having its problems, and you'll see the central banks of the world just totally.
You're watching Silver News Daily. Subscribe for more.
The Fed has failed. It's now too late for any rate cuts to save the economy, and a financial storm is brewing. Housing is about to collapse. Commercial real estate is on the brink, and when the dust settles, only those who prepared will be safe. But here's the shocking twist. The one asset that can protect your wealth in this chaos isn't gold, stocks, or bonds. It's silver. Yes, silver, and the reasons why will blow your mind. Stick with me as we uncover why silver is the ultimate safe haven asset and why you need to start stacking it now, before it's too late.
Starts to tank. Commercial real estate starts to tank, and stocks are pulled down even further by the real estate industry having its problems, and you'll see the central banks of the world just total panic, and they will jump back into the market in various ways. They'll cut interest rates again. They'll start buying up financial assets, and in a lot of cases, they'll start buying up equities too. The U.S. central bank really wants to be able to buy stocks directly because that's a very quick sugar high for the market, because you've got the equities, what's that called? Income effect or wealth effect. I'm sorry. When your stocks go up, you feel richer and you're more likely to buy stuff, and that stimulates the economy. So if the federal government can step in and buy equities, force the prices up, they've got a really quick way to stimulate the economy. They're going to do that this time around very probably, because they're going to be very short on tools that actually work when all of these over-leveraged sectors start to break down at the same time. And, what we've seen in the stock market these last few days, especially the Japanese stock market, is an interesting taste of things to come. Because Japan is basically the poster child for all the financial issues we're talking about here. And they're further along than we are towards the cliff that everybody's going to go off. So what happens in Japan happens here in a year or two or three or four. And Japan right now is in a box where the yen is tanking, interest rates are going up, and if they address either of those problems, they make the other one worse. So what they tried to do just lately is protect the yen by intervening in the foreign exchange markets, and that cratered their stock market. So interest rates are starting to go back up, stocks are falling very hard, and the Japanese central bank has no idea what to do about it. It's a big economy. So even if it's just Japan that runs into this kind of trouble, that'll affect the global economy because they're the third biggest economy out there. But since everybody else is headed in the same direction, I don't think it'll be just Japan this time. And everybody in the financial hierarchy knows that. And that's why you got these calls for emergency rate cuts, because they don't want this to go any further than it's already gone. They don't want they don't want a 10% drop in the NASDAQ to turn into a 90% drop like happened in 2000 when the tech stock bubble burst. So we're going to see central banks aggressively trying to lean against the crisis in whatever form it takes. And they're going to be bailing out everybody that is very loud and scary out there. So whether it's office buildings or other kinds of commercial real estate or housing or the stock market, the bailouts are coming.
The Federal Reserve has been the cornerstone of the U.S. economy for
what
decades,
that does is where things get interesting. And we'll find out pretty soon.
But what if I told you that this time the Fed's playbook is failing and there's no turning back? John Rubino, a renowned financial analyst, has been sounding the alarm for months. It points out that the Fed's relentless rate hikes, aimed at controlling inflation, have inadvertently set the stage for a financial disaster. Rubino explains that these rate hikes, which were intended to cool down the economy, have done more than just that. They've pushed the housing market to the brink of collapse. You see, the average American can no longer afford to buy a home because mortgage rates have skyrocketed alongside the Fed's interest rate increases. This isn't just a minor hiccup, it's a sign of a much deeper problem. But it gets worse. Rubino notes that the Fed's tools, like cutting rates, which have bailed us out in the past, are now powerless. Even if the Fed were to cut rates tomorrow, the damage has been done. The economy is already teetering on the edge, and no last-minute policy change can pull us back. The shockwaves of this reality are starting to ripple through the markets, but most people haven't fully grasped the implications yet. And here's the kicker. As the housing market collapses, it's not just homeowners who will feel the pain. The effects will be widespread, impacting everything from construction jobs to retail spending. This is the perfect storm Rubino warned about, and it's unfolding right before our eyes. The Fed, for all its power, can only watch as the economy unravels. Rubino's insight is clear. The system is breaking down, and traditional safety nets like the Fed are failing us. What does this mean for your wealth? It means you need to rethink your strategy immediately. If you rely on the old playbook, you're in for a rude awakening. The economic landscape is shifting, and if you don't adapt, you'll be left behind.
Start with the whole private equity landlord thing. Private equity companies are, in the aggregate, a plague in the United States. They basically borrow incredibly cheap money because they're Wall Street entities, and then they go around and buy up entire industries and ruin them by sucking out all the money via consulting fees and scams like that. And then they just dump those companies back on the market, but they're a husk of what they previously were, and their customers aren't being taken care of. And it's a mess, especially in healthcare and places like that. But they're also doing the same thing in real estate, where they're going around buying up entire neighborhoods, converting those houses to rentals, and then using algorithms to squeeze the most out of these rental properties by doing the least possible maintenance and charging the highest possible rents. So they're not like the neighborhood guy who you see every day, who you're paying rent to, and he owns the building you live in. They're anonymous corporations run by algorithms headquartered in big cities far away. And they're, ruining parts of the housing market too. And they're going to exacerbate the crash when it comes, because the way Wall Street works is they all pile into a bubble asset when it's moving, because they want to be part of this positive trend. And then when the trend rolls over, they all pile back out, and they make the subsequent crash much, much worse. They're going to do that with housing pretty soon. But they're not the only ones. The people who've been building Airbnb empires by buying 10, 15, 20 apartment units or small houses and things like that, they're finding out that it's not that good of a business after all. And they're in grave danger, a lot of them, because they borrowed a lot of money in order to build their little empires. And those empires are not paying back the kind of cash flow that are needed to cover the related debts. So you're going to see a lot of Airbnb properties be dumped on the market, along with these hedge fund private equity portfolios. And that's going to make what used to be a tight market in a lot of places exactly the opposite of a tight market. There's just going to be this deluge of new inventory coming on the market, and probably very few buyers, because at today's prices, virtually nobody can buy a house. Baby boomers already have their appreciated houses, and Gen X and Gen Z and millennials don't make the kind of money that allows them to buy today's appreciated houses. So the buyers are not going to suddenly step up when house prices go down by 5%, unless the government forces mortgage rates back down pretty close to zero. And that's where we get to your second part of your question about bailouts. The stock market has been tanking the last couple of days, and you already hear calls for emergency rate cuts by the Fed. And that's on a 10% drop in the NASDAQ. But wait till housing.
For years, home prices soared, driven by low interest rates and easy access to credit. But as John Rubino astutely observes, those days are over. The Fed's aggressive rate hikes have slammed the brakes on this runaway market, and the fallout is just beginning. Rubino highlights a critical issue: affordability. With mortgage rates now at levels not seen in decades, the average American simply cannot afford to buy a home. This isn't just a theoretical problem, it's a ticking time bomb. Home buyers are vanishing, and the inventory of unsold homes is starting to pile up. Sellers, once confident in a hot market, are beginning to panic. Prices are starting to fall, but it's not enough to lure back buyers. This is the kind of market correction that can quickly spiral out of control. And it's not just about individual homeowners. The broader economy is deeply intertwined with the housing market. Construction jobs, home improvement stores, even local governments that rely on property taxes, they all stand to lose as the market craters. Rubino warns that the housing market's collapse could trigger a domino effect, dragging down other sectors of the economy with it. Consider this. During the last major housing downturn in 2008, it wasn't just homeowners who suffered. The entire financial system was brought to its knees. Banks failed. Stocks plummeted and millions of people lost their jobs. We're staring down the barrel of a similar crisis today. But this time, the stakes are even higher. The Fed has fewer tools at its disposal, and the economic environment is far more fragile. Rubino's analysis is stark. If the housing market goes down, it will take much of the economy with it. The warning signs are all around us: rising foreclosures, plummeting home sales, and a general sense of unease in the market. But the worst part, most people don't even see it coming. They're still clinging to the belief that the housing market will bounce back, just like it always has. But Rubino argues that this time is different. The combination of high interest rates, declining affordability, and economic uncertainty is a perfect storm that the Fed can't fix. The collapse of the housing market is not just a possibility, it's an inevitability. And when it happens, it will be brutal. This is why positioning yourself now, before the crash fully unfolds, is crucial. The traditional pillars of wealth, like real estate, are no longer safe havens. It's time to start thinking outside the box, and Rubino suggests looking at assets that thrive in times of crisis, like silver.
Epic bubble over the last 10 years, so that it doesn't seem quite as frantic as the one that happened in the decade before. House prices are up more in this decade than in the previous decade, and they're less affordable than they've literally ever been. In other words, the average person can't even come close to buying the average house in the United States. Normally, that's a sign that you're at the top, and house prices have to go back down to the point that they're affordable again. And that's not happening yet, but there are signs that it's getting ready to happen, because the number of new homes and existing homes coming onto the market for sale is spiking, and in a lot of cities, it's going up dramatically. And that usually leads to falling prices, because when you have more houses for sale, it becomes a buyer's market, and sellers have to compete, and they compete by cutting prices, and then they panic when they see prices being cut, and you get a kind of a free fall in home prices for a while. That's what happened in 2008, 2009. Decent chance it happens again in the U.S. housing market right now. Now, over in commercial real estate, office buildings are such a mess. A huge number of office buildings went up in the last decade, and they were financed with incredibly cheap money. And they, at least initially, were pretty full of tenants, so they were generating enough cash to pay off their debts. Well, two things happened since then. One is interest rates have gone way up, which means the buildings that have to be refinanced have to pay way more for their new debt than they paid for their old debt. The second thing is that during the pandemic, a lot of people found out they like working from home way better than going into an office every day. So offices have lower occupancy rates now than they did and than they need really to be viable. So big office buildings are coming on the market. In a lot of cases, they're selling for a fraction of what they cost to build and what they were refinanced at and everything. So there's all kinds of losses in that sector that reside on bank balance sheets and insurance companies and pension funds, and are just now being realized. So you combine a housing bust, which is probably what we're headed for, and a crisis in certain parts of the commercial real estate market, and you've got a recipe for a general slowdown in an equities bear market, and the whole thing that comes with the cycle turning over. So I think real estate is it's not the only epicenter of the coming crisis, but it's one of them.
As the housing market teeters on the edge, there's another ticking time bomb that few are talking about: commercial real estate. John Rubino has been one of the few voices warning about the dangers lurking in this sector, and his insights are nothing short of alarming. Let's take a closer look at the situation. In the wake of the pandemic, The way we work has fundamentally changed. Hybrid working models and the widespread adoption of remote work have left office buildings across the country half empty. Rubino points out that these buildings, which were once bustling centers of business, are now becoming financial liabilities. Here's the crux of the issue. These commercial properties were financed during an era of ultra-low interest rates. Developers borrowed heavily, confident that they could fill these spaces and generate enough revenue to cover their debts. But with rising interest rates and declining occupancy rates, many of these properties are now worth far less than what was paid to build them. Rubino notes that this creates a precarious situation where property owners may struggle to refinance their loans when they come due, leading to a wave of defaults and forced sales. But it doesn't stop there. The implications of a commercial real estate collapse are vast. Think about it. If these properties continue to lose value, the financial institutions that hold these loans are going to take massive hits. Banks, insurance companies, and pension funds, all of which have significant exposure to commercial real estate, could face severe losses. Rubino warns that this could trigger a broader financial crisis, much like the one we saw in 2008, but with commercial real estate at the epicenter this time. Moreover, the ripple effects would be felt far and wide. Local economies that rely on commercial tenants could suffer as businesses close or downsize. Retail spaces, already under pressure from the rise of e-commerce, could seed even more vacancies, leading to blight in once thriving urban areas. This is a crisis that could spread quickly, affecting not just big cities but small towns across the country. Rubino's analysis makes it clear. The commercial real estate sector is a disaster waiting to happen. The combination of rising interest rates, declining demand, and over-leveraged properties is a recipe for collapse. And just like with the housing market, the Fed is powerless to stop it. The policies that created this bubble are the same ones that are now ensuring its destruction. So what does this mean for your wealth? It means that traditional investments, like real estate, are becoming increasingly risky. The smart money is already looking for alternatives, assets that can withstand the coming storm. Rubino suggests that silver, with its long history of retaining value during economic downturns, could be the lifeline investors need as the commercial real estate market unravels.
Epic bubble over the last 10 years, so that it doesn't seem quite as frantic as the one that happened in the decade before. House prices are up more in this decade than in the previous decade, and they're less affordable than they've literally ever been. In other words, the average person can't even come close to buying the average house in the United States. Normally, that's a sign that you're at the top, and house prices have to go back down to the point that they're affordable again. And that's not happening yet, but there are signs that it's getting ready to happen because the number of new homes and existing homes coming onto the market for sale is spiking, and in a lot of cities, it's going up dramatically. And that usually leads to falling prices because when you have more houses for sale, it becomes a buyer's market and sellers have to compete, and they compete by cutting prices. And then they panic when they see prices being cut, and you get a kind of a free fall in home prices for a while. That's what happened in 2008, 2009. Decent chance it happens again in the U.S. housing market right now. Now, over in commercial real estate, office buildings are such a mess. A huge number of office buildings went up in the last decade, and they were financed with incredibly cheap money. And they, at least initially, were pretty full of tenants, so they were generating enough cash to pay off their debts. Well, two things happened since then. One is interest rates have gone way up, which means the buildings that have to be refinanced have to pay way more for their new debt than they paid for their old debt. The second thing is that during the pandemic, a lot of people found out they like working from home way better than going into an office every day. So offices have lower occupancy rates now than they did and than they need really to be viable. So big office buildings are coming on the market. In a lot of cases, they're selling for a fraction of what they cost to build and what they were refinanced at and everything. So there's all kinds of losses in that sector that reside on bank balance sheets and insurance companies and pension funds and are just now being realized. So you combine a housing bust, which is probably what we're headed for, and a crisis in certain parts of the commercial real estate market. And you've got a recipe for a general slowdown in an equities bear market and the whole thing that comes with the cycle turning over. So I think real estate is it's not the only epicenter of the coming crisis, but it's one of them.
The Federal Reserve has long been viewed as the ultimate backstop for the U.S. economy, a powerful entity capable of steering us through crises with the flick of a policy switch. But what if that power is now just an illusion? John Rubino argues that the Fed's ability to prevent the looming economic collapse is not only diminished but virtually non-existent. And the implications of this are dire. Let's break it down. Over the past decade, the Fed has relied on a simple playbook: lower interest rates to stimulate growth and, when necessary, pump liquidity into the financial system. This approach worked to a degree in the aftermath of the 2008 financial crisis and during the initial shock of the COVID-19 pandemic. But as Rubino points out, these actions have led us into a trap. The problem is twofold. First, by keeping interest rates near zero for so long, the Fed has fueled massive bubbles in everything from real estate to stock markets. Now, with inflation finally catching up, the Fed has been forced to raise rates aggressively to cool things down. But here's the catch. Those rate hikes are now exposing the vulnerabilities in the very markets they helped inflate. The housing market, commercial real estate, and even stock markets are all teetering on the edge because they were propped up by cheap money for far too long. Second, Rubino highlights a crucial point. The Fed is running out of ammunition. The typical response to economic slowdowns, cutting rates, won't work this time because rates are still relatively low compared to historical norms, and inflation remains
if you're financially sophisticated enough to short things, in other words, to bet not on things going up, but on things going down, the last few days have been an epic opportunity to make a lot of money. If you placed a short bet, in other words, let's say you buy a put option on the NASDAQ, which means you bet that tech stocks are going to go down. You made a lot of money in the last few days. So if you want some action, that's the kind of thing that we're prepped for as a system. We're ready for the shorts to make a lot of money at some point in the not too distant future. And then as far as lifestyle goes, it's a good time to be handy, and it's a good time to acquire skills that allow you to, for instance, fix things when they break, or grow your own food, or handle a firearm if needed, things like that. If you don't already know how to do those things, it's time to kind of become a prepper. And it's time to make that list and tick that list off as you learn how to do things like that and connect with people who can teach you more, and build a community of people who see the world the same way and are ready to deal with hard times when they come. So all of that stuff is just out there, and we should all be doing it. And potentially we protect ourselves in a lot of ways. Potentially we make a lot of money if we do the investment part of this right. So this is, in one sense, an incredibly scary world that we live in right now. And in another sense, it's a world full of opportunities. So pay attention, look at, for instance, the people who come on your show have a lot of great ideas. So they watch a show like yours and learn from the people that are there sharing their wisdom. I think there's a way to come through this in great shape and to help your friends and family. And that's what we should be looking for.
Throughout history, during times of economic upheaval, one asset has consistently proven its worth: silver. John Rubino, an expert in financial markets, argues that as we navigate the current economic storm, silver is once again emerging as a critical safe haven. But why silver? What makes this metal so reliable in times of crisis? Rubino highlights several key reasons. First, silver has intrinsic value, unlike fiat currencies, which can be devalued by reckless monetary policies. Silver's worth is rooted in its physical properties and industrial applications. It's not just a shiny metal. It's a crucial component in everything from electronics to solar panels. This inherent value provides a strong foundation that isn't easily eroded by market fluctuations or central bank mismanagement. But there's more to the story. Rubino points out that silver, like gold, has historically been a store of value during periods of economic instability. When fiat currencies lose their purchasing power, precious metals like silver often see a surge in demand as people seek to protect their wealth. This isn't just a theoretical concept. It's a pattern that has repeated itself throughout history. During the Great Depression, during the stagflation of the 1970s, and more recently during the 2008 financial crisis, silver prices soared as investors flocked to this reliable asset. Moreover, Rubino notes that the current market conditions are particularly favorable for silver. With the Fed's policies faltering and inflation still a concern, traditional investments like stocks and bonds are looking increasingly shaky. In contrast, silver offers a hedge against inflation and a safe harbor from the storm. It's liquid, widely recognized, and crucially underpinned by both industrial demand and investor sentiment. Rubino also emphasizes that silver is accessible, unlike gold, which can be prohibitively expensive for many investors. Silver is affordable, making it easier for the average person to accumulate. This accessibility, combined with its historical performance, makes silver an attractive option for those looking to safeguard their assets without breaking the bank. But perhaps the most compelling argument for silver lies in its potential for appreciation. Rubino argues that we're not just looking at silver as a way to preserve wealth. We're looking at a metal that could significantly increase in value as the economic crisis deepens. With the demand for silver growing both from industry and from investors seeking a safe haven, there's a strong case to be made that silver's best days are ahead. In a world where the Fed's power is diminishing and traditional investments are increasingly risky, silver stands out as a beacon of stability. Rubino's analysis makes it clear that silver isn't just a defensive play, it's a strategic asset that could protect and even grow your wealth as the economic landscape shifts. As the crisis unfolds, those who have positioned themselves with silver could find themselves not only surviving, but thriving in a new financial reality.
Financial and lifestyle things that we should be doing in a world where these things that we've been talking about are in prospect now. Really strange, hard times might be coming. And one way you deal with that is, especially if it's a currency-related crisis that's coming, is you get out of the financial market, or the part of the financial market that depends on the value of fiat currencies for its value. So don't own government bonds, at least long-term government bonds. Short-term government bonds are much less risky than long-term. And be careful with bank stocks, and don't put all your money in a single local or regional bank, because bailouts are coming and bail-ins are possible, and there's no guarantee you get your money back in a timely way from a bank crisis. And gold and silver historically have done really well in these kinds of crises, although there's a timing issue there too, because they're getting smacked as we're speaking right now, along with equities. And that has happened in the last two bear markets, where stocks tank, and that pulls gold and silver down too, which in retrospect was a phenomenal buying opportunity, because they were V bottoms. Those precious metals tanked, they went down, and then they bounced right back off the bottom and went on to new highs. So we could be looking at something like that again, which means keep some powder dry. Have some cash with which to buy depreciated assets if we have just a general bear market where everything goes down, because it's completely possible there are some epic bargains created that are life-changing opportunities if you play them right. So own a fair bit of gold and silver, but be able to buy more if they tank here, because the government, when it comes in with its panic liquidity, will send gold and silver.
When it comes to protecting and growing your wealth in times of economic uncertainty, the choices can be overwhelming. Should you invest in gold, stocks, bonds, real estate, or perhaps something else? John Rubino has been clear in his analysis. While all these assets have their place, silver stands out as a uniquely powerful option in the current environment. But how does silver stack up against these other investments? Let's start with gold, often considered silver's older, more prestigious sibling. Gold has long been the go-to safe haven during times of crisis, and for good reason. It's durable, universally recognized, and has a deep history of maintaining value. However, as Rubino points out, gold is significantly more expensive than silver, which can limit how much the average investor can accumulate. This is where silver shines. It's often referred to as the poor man's gold because it offers many of the same benefits at a fraction of the price. In fact, Rubino argues that silver's affordability combined with its industrial demand makes it an even more attractive investment than gold, especially in a world where every dollar counts. Now, let's consider real estate. Traditionally, real estate has been viewed as a solid, long-term investment. Land is a finite resource, and property values generally appreciate over time. But as we've discussed, the housing and commercial real estate markets are on the verge of collapse. Rubino warns that the varied factors that once made real estate a safe bet, low interest rates and rising property values, are now working against it. With interest rates soaring and demand plummeting, real estate is no longer the secure investment it once was. In contrast, silver doesn't face these same vulnerabilities. It's not tied to a specific location or dependent on the health of the local economy. Silver is globally recognized and can be easily liquidated if needed, making it a far more flexible and resilient asset in today's volatile market. And what about stocks and bonds? Stocks, while potentially lucrative, are inherently risky, especially in a market as unstable as the one we're seeing today. Rubino has often pointed out that stocks are highly sensitive to economic shocks, and with the economy teetering on the edge, the stock market is no place for the faint of heart. Bonds, on the other hand, are traditionally seen as safer, but with interest rates rising, bond prices are falling, leading to losses for investors. Moreover, the returns on bonds are currently outpaced by inflation, meaning that bondholders are actually losing purchasing power over time. Silver, in contrast, offers protection against both market volatility and inflation, making it a superior choice to those looking to safeguard their wealth. Rubino's insight is clear. While gold, real estate, stocks, and bonds all have their roles, they each come with significant risks in the current economic climate. Silver, on the other hand, offers a rare combination of affordability, liquidity, and historical resilience. It's not just a safe haven. It's a smart investment strategy for those looking to navigate the stormy waters ahead. So, as you weigh your options, consider this. Silver doesn't just preserve wealth. It has the potential to grow it. With the economic landscape as uncertain as it is, the case for silver has never been stronger. Rubino suggests that those who diversify their portfolios with silver could find themselves in a far better position as the crisis unfolds. The key is to act now, before the window of opportunity closes.
It might look a lot like the last couple of days, and I, can't know for sure. Nobody can know for sure that this is the end of this very long, very extreme bubble, but that bubble is going to burst for sure. And we'll get an equities bear market. We'll get crashing asset prices. We'll get political turmoil. All of those things will be just part of the bursting of the everything bubble, and it's eventually going to happen. There are so many different things that could be a catalyst for that, and there are so many different ways it could go that there's no way to know for sure. But I'll tell you what, the Japanese market tanking is a pretty reasonable catalyst, and World War III. We're blundering into wars with multiple nuclear-armed countries out there in the world, and a shooting war with any of them would set off a financial crisis of epic proportions, I think. And right now in the Middle East, we're very close to something like that with Iran. In Ukraine, we're very close to something like that with Russia. And in China, we're just perennially picking a fight over there. So it's completely possible that all these financial things we're talking about end up not being the catalyst, and it ends up being some kind of a geopolitical thing. But the important thing to understand is that there's like 20 different things that can blow up blow up this market right now. And we can't know which one it's going to be. But I think there's a safe bet that one of them causes some serious trouble in the very...
We're living in unprecedented times. Markets are volatile, the economy is unstable, and the traditional pillars of financial security are crumbling. John Rubino has been sounding the alarm for months, and his message is clear. The time to act is now. Waiting any longer could mean missing out on the opportunity to protect your wealth and secure your financial future. Rubino points to the current economic indicators, which are flashing red. The housing market is on the brink of collapse. Commercial real estate is following closely behind. And the stock market is teetering with each new piece of bad news. Inflation, though somewhat cooled from its peak, still poses a significant threat, especially with the Fed's limited ability to control it without triggering a recession. All of these factors are converging to create a perfect storm, one that could sweep away the unprepared in a matter of months, if not weeks. The urgency Rubino emphasizes isn't just about protecting what you have. It's about seizing an opportunity before it's too late. Silver, he argues, is not only a safe haven but also a potential growth asset in this turbulent environment. As we've discussed, silver has historically outperformed during times of economic crisis, and the conditions today are primed for another significant surge. But why is timing so crucial? Rubino explains that as more investors begin to recognize the unfolding crisis, the demand for silver could skyrocket. This isn't just speculation. Look at what happened in previous economic downturns. Those who moved early into silver saw substantial gains as the metal's value soared in response to market instability. On the flip side, those who hesitated were left scrambling, often buying in at much higher prices or missing out altogether. Moreover, silver supply dynamics add another layer of urgency. Unlike fiat currency, which can be printed at will, silver supply is limited. As industrial demand continues to grow, especially in sectors like technology and renewable energy, this limited supply will only tighten further. Rubino warns that we could soon see a scenario where demand far outstrips supply, driving prices even higher. And it's not just about individual investors. Rubino notes that institutional investors, including large funds and even governments, are starting to turn their attention to silver as a hedge against broader economic risks. Once these large players enter the market in full force, prices could rise rapidly, making it even more critical for individual investors to act swiftly. Rubino's message is clear. Don't wait until it's too late. The window of opportunity to buy silver at its current levels is closing fast. By the time the broader market catches on, silver could be well on its way to new highs, leaving those who hesitated behind. The current economic environment is unlike anything we've seen in recent memory, and traditional strategies may no longer offer the protection they once did. Silver, with its unique combination of affordability, industrial demand, and historical resilience, offers a rare opportunity to not only preserve wealth but potentially grow it. So the question isn't whether you should consider silver, it's whether you can afford not to. As Rubino puts it, the cost of inaction could be far greater than the price of silver today. If you've been thinking about securing your financial future, now is the time to act before the opportunity slips through your fingers.
I'm not complimenting the dictatorships that are the leaders of the BRICS coalition. I'm not saying they're good guys or anything, but I am saying that they're making the correct moves when it comes to monetary policy. And a lot of that is in reaction to the U.S. We're using fiat currencies in the West as weapons against the rest of the world. So the rest of the world is responding to that by trying to set up their own monetary and financial system. And that means, replacing the IMF and the World Bank with their own organizations and the SWIFT International Bank Settlement System with one of theirs, and possibly a trading currency that is backed by gold and that they use to balance out trade flows among themselves and bypass the dollar in that way. There's an October 10th meeting. I think it's the 10th, but it's definitely in October, of the BRICS countries. And since just this last week, the European Union seized or seized frozen Russian assets and sent those assets to Ukraine. The BRICS countries are highly incented right now to speed up the process of de-dollarization. So it could be that we see kind of a dramatic announcement of some kind at the October meeting, and maybe it's that currency, or maybe it's that they're letting in a bunch of other countries. You know, the last time around, they didn't come up with a new currency, but they did admit Saudi Arabia into what is essentially an anti-dollar coalition. So maybe they'll do something like that again with some other important countries. We can't know that, but suffice to say that the BRICS countries are making the right moves. They're buying lots of gold, and they're encouraging their citizens to buy gold, and they're cutting bilateral trade deals with each other that bypass the dollar, and they're talking at least about some kind of a currency that makes the whole bypassing the dollar thing official. So this is a real thing. The BRICS countries own a lot of natural resources. They account for a big part of the Earth's population, and not a majority, but a decent size chunk of global GDP. So they're important, and the more we antagonize them, we in the West, the more likely it is that they take some pretty serious steps. And it's completely possible that at some point this threatens the hegemony of the dollar, and then leads to a falling dollar and rising inflation in the U.S., which, you know, is the last thing we need right now. But it's a complete possibility in the next few years.
To truly understand the power of silver as a safe haven and growth asset, we need to look at real-life examples of how silver has performed during past economic crises. John Rubino has frequently pointed to these historical instances to illustrate why silver is such a reliable asset in turbulent times. Let's start with the 2008 financial crisis, one of the most significant economic downturns in recent history. As the housing market collapsed and major financial institutions crumbled, investors scrambled to find safe havens. Gold and silver both surged in response, but silver's performance was particularly noteworthy. Between late 2008 and early 2011, silver prices skyrocketed from around $9 per ounce to nearly $50 per ounce, a staggering increase of over 400%. Those who had the foresight to invest in silver before the crisis reaped enormous rewards. Rubino emphasizes that this wasn't just a one-off event. Silver has a long history of shining brightest when economic conditions are at their worst. During the stagflation of the 1970s, another period of high inflation and economic uncertainty, silver prices also soared. In January 1970, silver was trading at around $1.80 per ounce. By January 1980, it had surged to an all-time high of $49.45 per ounce, driven by investors seeking refuge from the rapid inflation and economic instability of the era. But it's not just about historical performance. Rubino points out that the conditions we're facing today are eerily similar to those past crises. High inflation, rising interest rates, and a shaky financial system are all in play, setting the stage for another potential silver rally. The difference this time is that we're facing multiple crises simultaneously: housing, commercial real estate, stock market instability, and geopolitical tensions, all of which could drive even more investors towards silver. To illustrate this point, Rubino often references the surge in silver demand during recent economic shocks. For instance, during the initial outbreak of the COVID-19 pandemic, silver prices jumped from $12 per ounce in March 2020 to over $29 per ounce by August of the same year. This rapid increase was fueled by a combination of industrial demand, as silver is essential in medical equipment and electronics, and investor demand, as people sought a safe haven during the global economic uncertainty. Rubino argues that these real-life examples underscore a critical truth. Silver consistently accrues its value when other assets falter. Whether it's a financial crisis, inflation, or economic instability, Silver has a track record of not only preserving wealth, but significantly appreciating in value. This makes it an ideal asset for those looking to protect themselves from the unpredictable nature of today's economy. So, what's the takeaway? Rubino's insights in these real-life examples make it clear that silver isn't just a theoretical edge. It's a proven performer in times of crisis. If history is any guide, those who invest in silver today could find themselves in a strong position as the next wave of economic challenges hits. The examples are there for anyone willing to look, and the patterns are undeniable. Silver stands tall when other investments stumble. As we face an uncertain future, the question isn't whether silver will rise again. It's how high it will go and who will be wise enough to benefit. Rubino's message is clear. Learn from the past, act in the present, and prepare for the future by making silver a cornerstone of your investment strategy.
Ago, you had all the talking heads, including like Paul Krugman from the New York Times, Nobel Prize-winning economist, saying we've got this great economy, and the only reason people don't see it as the great economy is that they're ignorant. And so 1 month later, emergency rate cuts, please, save the economy from completely imploding. So this is one more example of expert failure, because there have been a huge long list of examples of where they lie to us about some big thing, or they honestly express their opinion and it turns out to be wrong, one or the other, and then people lose faith in that sector of the expert universe, whether it's the pandemic or whether it was Iraq's weapons of mass destruction, or a lot of the political things going on now where they're kind of lying about why lawsuits are taking place. And it just goes on. And the economy is going to be the big one when these guys spent the last year telling us we have an excellent economy and we should be grateful for the guidance that the economy's gotten from the people in charge. And that morphs into a flash crash that threatens to turn into another Great Depression, or depending on the response to it, another Weimar Germany hyperinflation. In the blink of an eye, we go from one to the other. Then we just lose even more faith in the people in charge right now. So at some point, that morphs into what the Austrian School of Economics calls crack-up boom, where people have lost faith so totally in the guys in charge that they lose faith in the money. And they dump it when they get it, and its value plunges, and the financial system breaks down. So let what's going on right now continue for just a little while longer, and we get into that territory. So fascinating times, Dunnigan, and potentially very lucrative if you play it right.
After examining the Fed's failures, the impending collapse of both the housing and commercial real estate markets, and the powerlessness of traditional investments, it's clear that we are on the brink of a significant economic upheaval. John Rubino's insights have guided us through this treacherous landscape, revealing the fragility of the systems we once trusted to protect our wealth. But now comes the critical question. What can you do to safeguard your financial future? The answer, according to Rubino, is simple yet profound. Invest in silver. As we've discussed, silver isn't just another commodity. It's a time-tested safe haven that has consistently proven its worth during times of crisis. But why silver? And why now? Rubino's analysis has shown that silver offers a unique combination of affordability, liquidity, and potential for significant appreciation. Unlike stocks, which are highly volatile, or bonds, which are losing ground to inflation, silver remains a resilient asset that holds intrinsic value. And unlike real estate, which is facing an imminent collapse, silver isn't tied to the health of any one economy or market. It's a global asset, recognized and valued across the world. But beyond its intrinsic value, silver's current market dynamics make it an even more compelling investment. Industrial demand for silver is growing, particularly in sectors like electronics and renewable energy. At the same time, the supply of silver is limited and mining new silver is becoming increasingly expensive. This creates a perfect storm where demand could soon outstrip supply, driving prices higher. Rubino suggests that this is exactly the kind of scenario where silver shines brightest when economic uncertainty is high and the traditional financial systems are in disarray. Rubino also warns that the window of opportunity is closing. As more investors recognize the looming economic crisis, they will inevitably turn to silver, pushing prices up. Those who act now before the rush stand to gain the most. It's not just about preserving wealth, it's about positioning yourself to benefit from the coming economic shifts. Silver, with its historical resilience and current market potential, offers that opportunity. In conclusion, the economic crisis we face is unlike anything we've seen before. The traditional safety nets of stocks, bonds, and real estate are failing, and the Fed is powerless to prevent the coming storm. But as Rubino has shown us, there's a way to protect yourself and even thrive in this environment by investing in silver. It's a move that's backed by history, supported by current market conditions, and crucially, it's a step you could take right now. So, as you consider your next financial move, remember this: silver isn't just an investment, it's your lifeline in uncertain times. Don't wait until it's too late. Start stacking silver today. Protect your wealth and prepare for what's to come. And as always, remember that this is not financial advice, but a perspective grounded in history and current economic analysis. If you found this discussion valuable, make sure to subscribe to our channel for more insights like this, and let's keep the conversation going in the comments. What are your thoughts on silver as a safe haven? Are you planning to add it to your portfolio?